Our 8-pillar process has proven to be a great way to screen companies, and it'll tell you a story on what questions to ask before you buy or ignore a company. So let's look at it right now. We're going to use Apple. This is our 8-pillar software. We go right to our 8 pillars. We type in Apple. Boom. So off the bat, it shows us the chart. We can go to a max chart, 5, 10, 1 year. We can do a custom everything. So I'm gonna look at the 1 year chart here. High of 183, low of 128. Now, some main takeaways here. It's gonna show you your dividend yield. It's gonna show you your free cash flow now in the last 5 years, return on assets, return on invested capital, your moving averages, things like that here that just give you a quick overview. But our first pillar is the 5-year PE being under 22.5. What this is it adds up all of the net income for the last 5 years and then takes the market cap and divides it by that total, the average of the 5 years of net income. We want that to be less than 22.5. On Apple currently, it's 33.5. So that would be an X. Now, does that mean the stock is overpriced? Hang on, not necessarily. If I were to tell you Apple is going to grow 50% a year for the next 10 years, you would be crazy not to buy it today, even at that number. So it all depends on growth and also the moat involved. Pillar number 2, we want the return on invested capital to be greater than 9%. This tells us what return do they get on the money that's invested in their business through debt and equity. That's the 2 ways to invest money in a business: take on debt or bring on equity. So if they're able to get a high return on that money, they're probably able to return that as time goes on, and you're going to get a compounding factor on the profit in the business. In this company, 33.4%. That's a huge number. We want it over 9%. This is almost 4 times higher. That is incredible. Pillar number 3, very simple. We just want revenue growth over the last 5 years. So we go to our income statement on our software, because our software includes the last 30 or more years of data for every company. We go 5 years ago, 247 billion. Last year, 386. That is definitely growth. That is definitely a check mark. Pillar number 4, we want net income growth over the last 5 years. Again, very simple. You just scroll down a little bit to the net income line. 5 years ago, 53. Last year, 102. Almost double. Another check mark. Pillar number 5. Now, guys, you need to pay attention to this pillar. This is the silent killer in investing, and everybody ignores this pillar. Nobody ever looks at this when looking at companies. Shares outstanding, are they increasing or decreasing? If they're increasing their shares outstanding, what they're doing is they're diluting you as an owner. If a company has 10 shares and you own one of them, you own 10% of the business. If they increase their shares by 2, from 10 to 12, you still own 1 share, but now you own 1 out of 12 shares, which is 8.33%, or is it 8.5? 8.33%. So you went from 10% ownership to 8.33% ownership. You have been diluted. Now, this is not the same as a stock split where they take 10 shares, make it into 20, but everybody gets more shares. Very different. This is you keep your shares and they're adding more shares, adding more essentially business partners to you to split profit and revenue amongst. This is a silent killer. So we go to the very bottom. We go to the end of 6 years, 20.9 billion shares. Last year, 16.28. Check mark. Now, really quick, does decreasing shares mean it's a good thing? Not necessarily. We don't want them buying back expensive shares. We want them issuing shares when it's more expensive, but you'll get in that when you look at other videos of ours about our 8 pillar, you'll get a feel for that. Pillar number 6 has to do with long-term liabilities, the debt of the business. Now, guys, debt for a company is just like debt for you. The more and more debt you have, the more and more likely you are to have financial problems. So I created this metric of taking the last 5 years of free cash flow, the average of the last 5 years. Remember, we saw that on this main metrics page. It's right here. For Apple, it's $75 billion. I take this number, I multiply that by 5. That is 375, call it, billion dollars. So we want their long-term liabilities to be under $375 billion. So what do? We go to our trusted balance sheet at the top. We're on quarterly. We scroll all the way to the bottom, and the long-term liabilities are 155. That is definitely below 375. That's a check. They can pay off, according to this, their long-term liabilities with 2 years of free cash flow if they just sustain the last average of the last 5 years. So that's incredible. Now, pillars number 7 and 8 have to do with free cash flow. That's the lifeblood of a business. There are 5 things you can do with free cash flow. All 5, none of them, one of them to any combination. You can buy back shares, pay dividends, pay down debt, make acquisitions, or reinvest back in yourself. You can do any combination of those things or none of them. So we go to the cash flow statement of our software. Now, guys, cash flow is cash from operations less your capital expenditures. The cash flow statement will not actually show you the free cash flow, but we put the line in here to make the math easy for you. 5 years ago, they had 54.7 billion. Last year, 106. Check mark, almost doubling again. And pillar number 8, we want to come up, it's kind of like a PE. We want to take a multiple of free cash flow to kind of see where we want to be in terms of market price. So we take the average of the last 5 years, which we put here for you. We multiply this by 22.5. Now, guys, I'm going to go off my math here. That's 1.5 trillion, another that's 1.65 and 30. So call it $1.7 trillion, roughly. Can we do the math here and see if I did it right? So 1.7 trillion. We go now to our market cap, which is on the main page. It is $2.3 trillion. So that's an X. Let's go to the 8 pillars tab. This does all the math for you right here, guys. Right here, all 8 pillars, 6 check marks, 2 X's. Now, the exciting part about this, guys, is on our software, we have a thing called the 8 pillars portfolio. So yeah, it's great to do this for one company, but what if you have a portfolio company? Let's say you have Apple, let's say you have Google, let's say you have Facebook, let's say you have Intel, and let's say you have Walgreens. You can put them all in here, and it'll give you the entire stats for your entire portfolio. And overall, this portfolio of 5 stocks are an 8-pillar portfolio. So, guys, this is what's so great. Now, the final aspect, once you have actually looked at all of these and done all of this stocks, now you have to sit there and ask yourself the question, well, what do I pay for the company? That's the important part, because we don't know the future, but every investment is the present value of all those future cash flows. What I urge you to do is to be conservative, make conservative assumptions, and hopefully you can buy the company based on a lower price of those conservative assumptions. So that's why we created a stock analyzer tool. It allows you to put those conservative assumptions in. Apple's revenue has been increasing a lot over the last 10 years. As time went on, the revenue was increasing, but I don't think that's sustainable for how big a company they are. It just makes sense. The bigger the company, the less likely it's to grow at higher rates, correct? So I'm going to be conservative. I'm going to call it 4, 6, and 8% revenue growth. For those of you who think I'm crazy, go back in history and look at companies that grew very quickly over a 10-year period. How did they do in the next 10 years? It's not as good, which is understandable. They already had their kick-ass part of town, okay? Profit margin. Now, profit margin, I'll probably keep pretty consistent. I'll go with 21, 22.5, and 24. Free cash flow, I'm going to look at this historical and say 24, 26, and 28. PE, I'm going to go with 15, 17, and 19. Because, guys, this company has a high moat. It's very hard to beat that with a high return on invested capital. So I'm okay with paying the low end of 15 on that one. And for my desired annual return, guys, for a company like Apple, I'll just take 12.5%. You might sit there and say, why so high? Well, guys, if I can get 9 or 10% by doing ETF over long periods of time. So give me a reason to buy this company. I hit the analyze button. The stock is currently at 132. And it's currently saying that based on these assumptions above, it might be a little expensive. We only have one metric that says check mark. But guys, we're at 132 and we have 116 and 102 very close. Now you might sit there and say, well, Paul, that's still 25% lower. Guys, remember, it was 183 just months ago, and now it's 132. These things will happen. Thank you very much, guys. Enjoy the 8-pillar process.